Okay, well, thank you, Bernard. It's a pleasure to be able to speak at Euroclear, and I'm delighted to be able to share with you some of the experiences we've had at the Bank of Israel in managing the foreign exchange reserves over the last decade or so, and some of the changes that we've made. It's a process, I think, in terms of adding risky assets to traditional central bank foreign exchange reserve assets that quite a few central banks have either taken or thinking about today. And what is interesting today, or in this sort of challenging times that we have, is that we have a really good stress test of some of the decisions that we made over the last few years, and see how we manage the volatility that's been going on in the market since February, and are we comfortable with some of those decisions that we've made. This slide simply shows you, I think, what most of you are familiar with, and that's the goals of foreign exchange management. We've talked quite a lot about this sort of holy trinity of maintaining purchasing power, managing the reserves with high liquidity, and third, achieving an appropriate return on the reserves. Now, traditionally, the first two have had a lot more weight in the deliberations of central banks than the third one of return. Even in the issues some of we've had in looking at liquidity, it's not clear what liquidity is. Sometimes you can simply thinking about it as your ability to sell assets quickly at a low cost. But it may be that you don't want to sell an asset, even if it has high liquidity, at a certain time in a crisis, because you'll be realizing losses. So equities, if you think about them, when we want to access $1 billion worth of liquidity and sell an asset to do it, US equities can be as liquid or even more liquid than many traditional reserve assets, whether it be Eurobonds or whether it be TIPS. Liquidating $1 billion equities can be easier, but you might not want to do it at a certain level in that time. Having said that, I think as we've gone forward, a lot of central banks have begun to think about giving more weight to that third goal, the goal of having an appropriate return on your reserves. And that's been a function, I think, of two things that have gone on. One has been more transparency on releasing data on the returns on the reserves. And the second one has been an increasing size of reserves for many central banks, and therefore the weight of those reserves requires to give more stress to the return on those reserves. Just to give you an idea of where the reserves are now compared to where they were a decade ago. So a decade ago, we were invested, over half the reserves were invested in government bonds. About a quarter was invested in what I'd call quasi-government bonds, whether it be agencies or KFWs or CADIS Eurobonds. And another sort of quarter was in cash or money market products, be it deposits or CPs. Today, 2020, well, we have assets now such as equity. We're around 15% of equity. We were 15% at the beginning of the year. We've gone down to 13%. Corporate bonds have been added. Interestingly, the government, you can see here the government bond section is in fact larger than it was before. What's actually been reduced to finance these new investments of equity and corporate bonds has been the quasi-government bonds and the cash and money market products. The rationale, which I hinted at before, behind this last change has been the increase in the size of the reserves. The reserves have grown from 25 billion just before the 2008 crisis to over $160 billion today. In terms of, let's say, as a percentage of GDP, that's a rise from around 15% to close to 40% today. So clearly, because we're managing a very large section, sort of source of the wealth of the country, we need to be spending a lot more attention to the return on those reserves and not just the liquidity of them, because, well, as far as because we've realized we have sufficient liquidity, or easily enough liquidity, that we can have other assets in our portfolio that we don't need to worry about selling them in a crisis. We can just wait through the crisis and not sell those assets. Just as this just gives you a different way of looking at it, you can see the rises in the equities there, which are in the light blue. We started off on a sort of gradual process. We started in 2012 with a pilot investment of 3% of the reserves and slowly increased it. And then around in 2015-16, we started a similar process with corporate bonds. We've always gone for this process of, first of all, using a small investment to get familiar with the asset class, to understand it, and then later to ramp it up as we feel that we begin to get more comfortable with that. The equity portfolio was built up firstly in that initial pilot portfolio with just a 3% investment in the US equity market, and then we expanded it to other markets, initially the large markets in Europe, and then to more or less a large section of the MSCI developed market index, just not investing some of the very small markets. It just wasn't worth our while. One of the issues that came up was whether to do it in a passive or an active management format. We went for the passive format simply because we didn't think that active management necessarily in the very developed markets where information is freely available, that it would give over time a return that justified either the fees or the additional noise that sometimes active management gives you. So why equities? Why did we think about equities first in terms of for adding to that government bond portfolio that we had before? Well, the obvious reason is the equity risk premium. What we're looking to do is to add assets that will give us risk premium. We can harvest those risk premium and different types of risk premium. So equities, we know that the long-term risk premium is somewhere between 6 and 8%. This is a long-term graph showing what happens to the return on government bonds compared to equities. It's a cumulative return. And the thing about cumulative return is over a 1 year, 2 year, you don't really notice it to such an extent. But when you start to look over 10 to 20 years of returns, it starts to mount up. And then you start to think about, well, shouldn't I have been doing that some time ago? The thing about equities, obviously, is that not only are you expecting more return, you're expecting more more volatility. Now here we have we have the yearly we have a rolling 1 year holding period returns. The blue line is the Standard & Poor's 500. The red line is US Treasuries. Now clearly from this you can see that US Treasuries, as we expect, are far less volatile. There are also very few periods when you have negative 1 year rolling period returns on that asset class. Compare that to equities, where there are several periods throughout this where you've had negative returns. The 2001-2 NASDAQ crisis, 2008, the Lehman Brothers crisis, and if you were to look at 2020, you would see a certain part of that also a negative returns over a 12-month horizon. These are on the US market, but you see a similar picture in other markets. The other reason I think for sort of pushing us into looking at other asset classes rather than just treasuries or bonds or the traditional high-grade government bonds has been the long-term decline in interest rates and yields over the last 20 years. Something that on the first part of it actually gave tremendous returns to government bonds as you got capital gains on them. But once we started getting past 2011, 12, bond yields still came down, but they started to get close to zero. And in some markets, as we know, and here we have in red, the German 10-year bonds, they've gone negative. So you got to start asking yourself, do I really want to be holding so much of my portfolio in an asset class that is unlikely to give me positive returns or significantly positive returns over the next 5 to 10 years? And I think this is something that has catalyzed the search into other asset classes. If you think about it, that was exactly what monetary policy was trying to do. It was trying to push people, investors, to go into different asset classes and pull down the returns in corporate bonds or other sort of mortgages and that like. Here, what we see here is just a plot of risk and return in two different periods. On the left-hand side, you see risk and return in the 2000 and 2015 period, and we're plotting different asset classes there. And on the right-hand side, we simply take what we use BlackRock, just what they think will be the 5-year returns going forward. Now, the thing is, in the last sort of that period of 2000, 2015, because of that decline in yields, actually government bonds were a fantastic asset class. And they actually produced, if you look there in the top there, on the top left-hand side, you can see that US 5 to 10-year bonds were giving a similar return to equity, but with far less risk. So it wasn't a bad thing to be in that period. But as you come forward, you can't think you're going to get those similar sort of returns from government bonds that you did in that 2000 to 2010-15 period. So you have to start thinking about other asset classes if you want to get some form of return from it. And you can see in the sort of BlackRock's 5-year projections there, the bond products are all in that bottom left-hand corner with either negative or very low yields. They still think that equities will produce a 5 to 6% premium going forward. Time is important. The longer you can look forward, the longer you can hold an investment, you begin to harvest those risk premium. And here we're just taking two different periods, well, one sub-period, and looking at the differences between a portfolio, which is the blue line, which has 15% equity and 85% bonds, compared to the traditional portfolio that we had before, which was 100% bonds. In each case, we've got, let's say, a 70%, 30% US, European slant in that portfolio. Over the whole period from 2000 and let's say 2006 to 2020, then you're talking about a 1.1% improvement in return. When you look at it over the whole period, you can see the difference there. You're picking up an extra like I think it's like 15% of return over the whole period. If you look at the 2011 to 2020, which is actually the sort of relevant period for the decision we reached in 2012, the pickup in yield from that changing to that other portfolio is around 1.9% per year. This was actually useful for us because when you look at that period of 2011 and 2020, the foreign exchange reserves, when you measure them in shekels, in a local currency, well, you're having some form of losses simply because the appreciation of our own currency of the shekel. And the appreciation of the shekel over that period was around 1.8%. So actually, we were managing to cover the impact of the appreciation of the shekel on our balance sheet by having assets that were giving more return than they did before. Now, this rather pretty colored graph that you can see in front of you, it shows the distribution of different portfolios over time. And we have three portfolios here. There's portfolio A, which has 15% equity, portfolio B with 20% equity, and the third one, which has a 30% equity. And we plot the distribution of returns over different holding period returns. So it's either a 1 year, 2 year, 3 year, 4, and a 5 year. What you can see, obviously, is the longer the horizon, when you move from the 1 year to the 5 year, towards the 5 year horizon, the distribution moves downwards, which is positive returns. Now we have, first of all, you can see that in the initial portfolio, even over a 1 year horizon with 15% equities, it's fairly rare to have negative returns. If you go to a 30% portfolio over a 1 year horizon, you do have negative returns. Some of the distribution is negative. But if you can actually wait that out and look at a horizon that is longer, 2 or 3 years, you'll actually have very few periods with negative returns. The rationale of being able to look through that short-term volatility is if you have larger reserves, if you don't need to liquidate a large part of those reserves over time, and therefore your investment horizon can be longer, and therefore you can think about adding a larger percentage of riskier assets. The other thing about adding equities or adding other asset classes is you want to look for asset classes that actually have a low or negative correlation with the bulk of your portfolio, which continues to be government bonds. So this is a table which looks at, in the upper part of it, looks at correlations between different asset classes since 1993. So it's a long-term view on correlation. And what you can see here is that the asset classes that give you negative correlation, which is what you're really looking forward to for when you add them to a government bond portfolio, are high yield and equity. MSCI US is the equity portion of that. Which both have negative correlations compared to the US 1 to 10 year bonds. The advantages, so when we looked at this, the advantages that we thought of comparing US high yield and equity was that equity is actually far more liquid than US corporate high yield bonds. And so it meets two of our requirements. It meets the requirement of adding return, and it meets the requirement of having at least some good liquidity if you want to make changes in your portfolio. Here I'm not talking about liquidating my portfolio. I'm just making changes, from time to time when you do a new investment process and you want to change a certain amount of percentage of your portfolio. It's actually quite easy to do with equity, something that you can't be said if you've got a portfolio of high yield bonds. The other thing about it is that equities actually have quite a lot higher volatility than US high yield. So you may think that's actually a bad thing, but we looked at it as actually as a good thing. We're looking for volatility because we're looking to be able to add an asset in a small amount, but get a lot of what I would call oomph with that asset class. And that's what equities give you. They give you correlations, but you want negative correlations, but they also give you sort of in terms of pound, sort of buck for your percent of investment, they give you a lot of sort of effect on your portfolio, and that was exactly what we were looking for. So we didn't have to sell a large amount of our government bond portfolio to get added volatility and added returns to that portfolio. The one sort of worrying caveat that I would talk about on that is that correlation is not stable. So although in the last decade, there has been negative correlation between, especially in crisis periods, between US equity and US government bonds, you can see that correlation is beginning to shift and becoming less negative. And if you think about it, where yields are today, it's difficult, even if there is a further period of volatility and crisis, to see that you're going to get tremendous capital gains from that bond portfolio, because how low can the 10-year yield in the US go? Well, I've been saying that for the last 10 years, but now that they're down to about 0.7%, I think the upside seems to be fairly restricted, and that's going to be reduced amount of protection you get from your bond portfolio to help you through those periods when your equity portfolio is going to be going down. Just one other thing that we looked at, which was do you go into just the market weights index on equities, or did you look to go for some smart sort of index that people tell you is going to outperform the market cap index? And there are various different types. There's a sort of min variance indexes that you can use for equities. There's a value index. There's an equal weight index. We did look at this, but I think one of the things is you need an awful long horizon to be able to ride out the noise that sometimes you can get for it. Some of these indices, although if you look over a 30-year period, they may do well, they can really underperform over a 5-year period. And this is something we actually experienced when we did a pilot program on this. And in fact, we decided that the smart beta wasn't worth either the money or the sort of the effort in terms of looking at it. And we went back to simply a market cap portfolio. One thing I would say about it, and this all looks very good, and looks like equities is a fantastic investment, but all the sort of work I've shown you there is actually from the US and on the European equity. The nightmare scenario would be what happened to Japanese equities in the 80s and 90s, when they just didn't come back. So it didn't matter if you had a 5-year horizon or a 7-year horizon, you didn't make your money back for 10, 15 years. That's something that you have to have at the back of your mind and think about it when you make that investment decision that you'd go into equity. It may not always be the best bet that you can possibly think about. There are risks there, even when you have a longer term horizon. And this is something we obviously will look at in terms of valuations on equities. Maybe equities are becoming too expensive. There's a timing issue. You don't want to start the process of investing in equity just about when they're at very expensive levels, and you're going to get losses right at the beginning of that experiment. We were lucky. We were managing to ramp up our investment in equities at just the time that it was a fantastic bull market. So you do need some luck. Obviously, PE ratios are now pretty high in the recent period, but some of that is just to do with the fall in the discount interest rate that improves the valuation in equities. But it's still something that you have to think about carefully. Lastly, and I'll just spend a minute just talking about investing equities or investing in risky assets in the culture of a central bank. The two don't naturally go together. Central banks are very professional and very experienced at identifying risks and avoiding them. That's what we do through most of the things we look at, whether it be monetary policy, whether it be bank supervision, whether it would be financial stability. We look at risks to avoid them. But when you're investing in risky assets, you want to identify risks, but you identify them in order to enjoy them. You're actually looking to harvest risk premium. And sometimes that's a difficult process to get people to change their mind thoughts about as you invest in an asset. There are other sort of interesting sort of quirks that happen. When we had a government bond portfolio, and we'd do our annual return and we'd write a report on it, we were spending like pages and pages explaining a few basis points of outperformance or underperformance. And the whole year, the outperformance and underperformance could be 10, 15 basis points. When you have equities, 15% equities or 20% equities in the portfolio, you get that on a daily basis. You have to be able to handle that volatility. And in the end, what you really have to do is you have to educate both the public and your management board that they can live through with that they understand the risks that you're taking, they understand why you're taking their risks, they're comfortable with it. So precisely when you get into a period like we were in February, March, you don't panic and you don't sell those risky assets at the worst time. It's a long process. It's one that's ongoing, but it's one that's essential to when you look to add risky assets into a central bank portfolio. Thank you very much.